The debt ceiling is a limit set by the legislative body of a country on the amount of debt that the government can legally borrow. It represents the maximum amount of money the government can borrow to fund its operations, including paying for existing obligations and funding new programs. In the United States, for example, the debt ceiling is determined by Congress. When the government approaches or reaches the debt ceiling, it cannot issue new debt or borrow more money without an increase in the ceiling approved by Congress. If the debt ceiling is not raised in a timely manner, the government may be unable to meet its financial obligations, potentially leading to a default. The debt ceiling can have several effects on the stock market. Investor confidence. The debt ceiling debates and potential government default can create uncertainty and undermine investor confidence. This uncertainty can lead to market volatility, as investors may become more cautious or even sell off their holdings. Interest rates. If the government defaults or there is a risk of default, it can negatively impact the country's creditworthiness. This may result in credit rating downgrades, which can increase borrowing costs for the government, businesses, and individuals. Higher interest rates can reduce corporate profitability and consumer spending, affecting the overall economy and stock market. Government spending and economic growth. When the debt ceiling is reached, the government is limited in its ability to borrow money to fund its operations. This can result in spending cuts and austerity measures, which can negatively impact economic growth. Slower economic growth can affect corporate earnings and stock market performance. Confidence in government. The debt ceiling debates can erode confidence in the government's ability to manage its finances effectively. This loss of confidence may have a broader impact on the economy and financial markets, as it can affect business and consumer sentiment. The debt ceiling has had a notable impact on the stock market in the past. Here are a few historical instances that illustrate this relationship. 2011 debt ceiling crisis. In 2011, the United States experienced a significant debt ceiling crisis. The political deadlock over raising the debt ceiling led to concerns about a potential government default. The uncertainty surrounding the situation caused increased market volatility, with the stock market experiencing a sharp decline. The S&P 500 index dropped nearly 17% from July to October of that year. 2013 debt ceiling debate. In 2013, the US faced another debt ceiling debate, resulting in a partial government shutdown. The uncertainty surrounding the potential default led to market unease and increased volatility. Although the stock market recovered shortly after the resolution, the period of uncertainty caused fluctuations and temporary declines. 2018 debt ceiling agreement. In 2018, the US government reached a bipartisan agreement to suspend the debt ceiling until 2021. The resolution provided certainty and removed the immediate risk of default. As a result, the stock market remained relatively stable during this period. It's important to note that the impact of the debt ceiling on the stock market can vary depending on various factors, including the severity of the crisis, the response of policymakers, and broader economic conditions. The degree of market volatility and investor sentiment can differ from one episode to another. However, in general, the uncertainty and potential consequences of a debt ceiling crisis can lead to increased market volatility. Please check out our channel NKK Investing for more videos about the stock market.